In today's video, I'm going to share 10 of the most important lessons that I've learned as an investor who has bought over $500 million worth of investment property myself and my clients over the last 10 years. These are the ideas and insights from my obsessive nature over the last 15 years of trying to figure out everything Australian real estate, and not just the simple stuff that you see online, but the complex, detailed data, history-backed stuff that can help you invest so much better moving forward in your future. The first thing I wanted to talk about today is this concept of longer-term real estate cycles. Now, 3 phenomenal books if you're more interested in going and finding out about this. Number 1 is The Secret Wealth Advantage. Number 2 is The Secret Life of Real Estate and Banking. And number 3 is The Power in the Land. Now, these books will not only change your life so much for the better as an investor, but will give you a guide based on 200 to 350 years worth of history about the nature of the economy and how money moves around and creates cycles of basically boom and bust relating to property around the world. Now, basically what I read in these books is this concept of the 18.6 year real estate cycle. And all the authors did is went and looked at the economy for the last 200 to 315 years and found the 18.6 year cycle. Now, I've done previous much deeper versions of this video where I completely draw it out and explain it as well. And obviously the books are a phenomenal guide too. But in a nutshell, we come out of a GFC style event and the market goes up for about 7 years. Then the market goes, shit, we've all gone up. Sydney, Melbourne's expensive, stock prices have recovered, and the governments around the world generally pull the market back so it just doesn't go absolutely ballistic. Now, this pullback, the last time we did this was during COVID. They also did it in the dot-com boom and bust, the Cuban Missile Crisis. In fact, there's like countless examples in the last couple of 100 years of this happening, and that period's called the mid-cycle slowdown. Generally during that period, we see property prices and stocks go down, but we get out of it pretty quick. And then we go into another period of growth, which is the second phase of the real estate cycle. And effectively in this point, everything sort of goes up that hasn't gone up yet. So secondary cities like Brisbane, Adelaide, Perth, stock markets crank, things like crypto cranks, commodities crank, all of those sorts of things. And then we get this insane winner's curse phase or massive boom at the top, which rinses the last bit of growth out of the market, where we get to this point where the weakest part of the financial system globally cracks, and then we end up in another sort of Great Depression, GFC style event where historically stocks have come down sort of 35 to 60%, and prices around the world, depending on where you are, generally come down between sort of 8 to as much as 40% in some of the European and American countries. Now, I know that's a lot to take in and a way to start this video, but an understanding of the movement of money and how things go up and what things go up at different times can be a monster advantage as an investor. Now, I've been personally investing for the last 15 years, bought over $500 to $550 million worth of property for clients and many properties for myself. Thank gosh I don't own them all anymore because it would be a monster headache. But effectively, that knowledge of the long-term real estate cycle has made me sleep better, make much better decisions as an investor, and enabled me to leverage up during safer historical times when things are more likely to be good, and deleverage and move into safety at times when historically it's going to be bad. But an understanding of this stuff has completely changed my life and is well worth a look at if you're a bit of a data history geek like myself. Whew, that was a mouthful. Now, moving on to the second lesson that I've learned from buying what I've bought, and that is this concept of leverage. Now, one of the main reasons I invest personally in property is because I can leverage my money at 1 to 5 times or 1 to 10 times, depending on what the banks are lending. So let's go out there and say that you've got $200,000 right now in savings and you decide to put it into a stock market. Now, I was recently doing some videos with a financial planner on self-managed super funds and long-term financial planning, and stocks have absolutely beaten the long-term performance of property. There's absolutely no doubt, no questioning which is better as a long-term asset class in terms of year-on-year performance for growth. Stocks have done about 8 to 9% per annum over the last 100 years, where property has only done about 4 to sort of 7%, depending on which market you're looking at. But stocks are very, very difficult to leverage without very, very high volatility and risk, where banks in Australia and around the world love lending money for property. So if you've got $200,000 right now and the stocks go up, you've just got it in a low-cost Vanguard index fund or I-500 stocks or whatever you want to do, just the average American index, that 200K going up by 8% in the first year means that you've got a $16,000 gain. Now, if you were to use leverage through property, which is what I've been doing for the last 15 years, and I put that same 200K into $1 million asset, even if that property only goes up by 5% or 6% in that first year, you've got around about a $50,000 to $60,000 gain on that same 200K versus a 16K gain. And this is why leverage is so important. Now, one of the boys in my team here at Pumped on Property is an accountant. He's very, very clever, and he talks about the power of using leverage while you're young. And then probably at some point in the future, like many, many wealthy and successful investors get to, they end up getting the shits with the maintenance and the costs related to property. And ultimately, when you've got a couple of $1 million property and it's only renting for $1,000 a week, they sort of get the shits with the return on cash for that property as well. And based on the advice of their accountants or financial planners, often go looking for sort of simpler, more set and forget, easier asset classes once they've built that cash up. But for me personally, as a young person, I've really just been using property for leverage to get much, much better returns than I can on the low amount of capital that I started with in the stock market. But take all of that with a grain of salt. Obviously, I'm a property guy. I use it for the leverage at the moment, but there's many, many people doing well in commodities, things like gold, currencies, crypto, businesses, stocks, bonds, and all of those other incredible asset classes that are so worth getting your head around as well. Now, the third lesson that I've learned as an investor is probably from making a shitload of mistakes. I feel like I've made absolutely every mistake that you can ever imagine as an investor. But what I've kind of learned as I've gone through this journey from listening to literally tens of thousands of hours of property podcasts, from talking to over 5,000 or 6,000 investors now, and from helping 1,000 people plus buy property, as well as obsessively looking at history, reading, and the market data at the moment from Australia's leading economists and analysts, is that there are things like in every single part of our life that can make it easier. And before we talk about what really works with property, if you think about it from a training or a health perspective, we know that eating well, sleeping well, drinking enough water, hanging out with cool people, spending time with your family, and certain training related behaviors can have a massive, massive positive impact on your overall physical and mental health. And it's the exact same thing with property, but for some reason, when we're looking at the health side of our lives, we're extremely disciplined, consistent, and we follow the rules. And myself included as a property investor, there wasn't just this like guidebook of this is what works. Now, if we think about the history and what really has worked in Australia, Australian residential property, according to John Lindemann, over the 100 years leading up into the 2000s, had averaged about 11% per annum. According to Simon Presley, house prices in Australia over the 50 years ending in 2022 averaged about 8.2% per annum, making it one of the top performing leveraged assets in the world over that 50-year period. Now, when we look back at what works, houses and townhouses have massively outperformed units, whether that's in Australia's capital cities or regional markets around the country over the last 30 years, according to CoreLogic. In fact, they've smashed the performance of units by over 125% during that time. Now, similarly, capital cities in Australia, when you look at all of the regional markets in a basket, have absolutely smashed the performance of the regionals, again, beating them by more than 120% in the last 30 years, according to CoreLogic. But I saw another chart recently where they looked at the the major regional markets and the major capital cities or metro markets versus just all of the regional markets. And major regional markets like Newcastle, Wollongong, Sunny Coast, Goldie, Mornington, Geelong, etc. can do very, very, very well as well. In fact, some of the top performing markets in Australia like Byron, the Goldie and the Sunshine Coast in the last 10 years have actually smashed the performance of some of the metro areas post-COVID. But if you just stick with houses in metro markets or major regional markets, you're going to put yourself or your family in a much stronger position longer term using history and what works as your guide. Now, on top of that, I like to buy land because the land or the power is in the land, as Fred Harrison said in his book. But land is where the gains are and the asset on top is declining over time. So the bigger, the better. But for me personally, I like to buy land between the 1,000 to sort of 6,000 square meter range. But most of my properties are in that sort of 500 to 1,000 square meter range. I like to buy properties close to the city of these regional or metro markets or very, very close to the beach. And then putting yourself emotionally into that position of what would I live in or what would my parents have bought when I was growing up. So quality suburbs in quality parts of the city, nice quiet streets, no housing commission, no flooding issues, no landslide overlays. We don't want to be buying on main roads next to the cemetery or the school or the uni or the commercial. We just want that simple set and forget larger home on the larger piece of land that's very, very low maintenance that you can set and forget. And obviously as a business, we use about 150 other indicators on top of these. But really, if you stick to the fundamentals of what has worked, that's what's going to continue to work into the future. Now, the fourth lesson that I've learned that I did really, really badly, I know this is shocking to say, but I'd bought 9 properties personally by about my 31st or 2nd birthday without even really having a plan or clarity for my financial future. And I know that's bad to say, but at that time, all I was reading and hearing was go big or go home, 10 properties in 10 years, how I went from 0 to 150,000 properties or whatever the book was, 100 and something odd properties in 3 years. Like it was all about more is better versus quality is better and understanding history is better and making smart decisions is better. So for me personally, the biggest mistake I see from speaking to over 600 investors every single year is lack of planning and lack of clarity about how they're going to move towards their financial goals. Now, a great place to start is obviously the podcast and the books, but I think sitting down with a financial planner, an accountant, some family members or some friends or acquaintances that are doing well can be a nice place to start. If you don't have those people around you and you don't want to spend money on them, then another great place to start can be as simple as what are you earning right now? And let's aim to replace that with a passive income through property over the next 15 years as a starting point. So if you're earning 80K or 800K, then a really nice starting place is to replace what you're currently earning. Now, obviously it's going to take a lot more risk and a lot more time to do something big in the hundreds of thousands of dollars a year, where it's much easier to replace something like 100 or 150K over the coming period of 15 years. So from a planning perspective, it's as simple as going, well, this is where I'd like to be, and then reverse engineering it back. Now, I've done videos on this, like the 2 properties and the 3 properties, the financial freedom strategies, where I talk about the 3 phases of creating financial freedom and financial peace for your future. You can go check out those on our YouTube channel or our podcast, but effectively, the first step is buying or accumulating the properties that will make you financially free in the future, whether that's 7, 15 or 30 years from now, depending on your risk profile and goals. And then once you've bought those properties, you move into the second phase, which is paying down debt or consolidation phase. And in those videos, I talk about 5 ways to pay off your properties over the next 15 years without sweating too much and being still able to completely enjoy your life. And then the third phase is choices and freedom, financial peace, passive income for life, and a very, very strong wealth position that will make retirement simpler and easier for you as you move forward. But planning is so important. I think it's the number one thing that the investors that I speak to miss, which also kind of leads me into the next one, number 5, and that is having a really, really strong vision for where you're going or why you're investing in property. Now, I think from my experience, I've always had a very, very, very clear vision as to why I wanted to invest in property. And that was to spend more time with the people I care about, to help set up my family, to give myself financial freedom in retirement, to give myself choices earlier in life. But there was a lot of softer things in that as well. Like, I love training, I love surfing, I love hanging with my kids, I love going to their sports. I love being a really active dad and getting to sometimes drop off or pick my kids up from school. I love being able to take time off during the year, during the school holidays with my kids. I love traveling, I love caravanning. I feel like I'm just the kid in the candy store. And I know so many of you guys are the same. And I think so much of financial freedom and property stuff is related to the numbers and the tax benefits and the structure. And it's like, actually, property is just a vehicle to get you from where you are now with leverage to where you want to be sooner. Because we know that it takes from 20 to 70 years for the average person to end up on the pension. But what if you want to get there at 60 or 50 or 40 or 30? And that means having a vision for the type of life that you'd like, the service that you'd like to bring into the world, and the people that you'd like to help in the future. And just, why not become that person in your family that completely breaks the family line? You hear so many great motivational videos about being the first person to go to uni, or the first person to have a great long-term relationship, or the first person in a family line to create financial freedom and financial peace, and to completely become the next version of what you or your family's supposed to be. And I really resonate and vibe with that stuff as someone who started with absolutely nothing and has just consistently taken disciplined action with a plan towards my vision over the future. Now, a great way to do the visioning stuff is to just write, for me, or the way that I do it is write, I'm 100 years of age today. I know this is a bit philosophical or strange for a lot of people, and I'm so grateful for. And I write all of the things in my life I'm grateful for. And it's never like another zero in the bank or a Lamborghini. It's always, I'm so grateful I got to see my kids and my grandkids and my great grandkids. I'm grateful I got to travel the world. I'm grateful I got to give $1 million to charity. I'm grateful I got to help my brothers and sisters pay off their properties outright. Like, so much of the stuff is about how I can help. I'm grateful that I got to train, I got to surf, I got to whatever's important to you, And so I think that's one way to do it. But what we're trying to discern is the life that you're moving towards and the person that you really are and who you're supposed to be. So planning and vision's really, really important. Now, going from the sort of philosophical, esoteric stuff back to like the hard data stuff, another one of the lessons that I've learned is that this idea of market timing. And we can never perfectly predict the market tops or the bottoms. Obviously, every single piece of research ever says that it's much better to be in the market than to try and time the market. There's some phenomenal stuff in stocks and commodities and property online about this stuff. But effectively, Australia is not one property market. And it's so normal for the average investor to go, well, Australia's going up or Australia's going down. Or the average person feels good and sentiment's high, or the average sentiment's really low. And we sort of get influenced by so many people, advisors, and the media in our lives relating to the property market that we often miss that longer term cycle. Now, from what I've learned from looking at those books and the 18-year cycle from an Australian perspective, is not all markets go up at the same rates at the same time, and you can pick your way around Australia based on history. So generally after a GFC, when we go through that first stage that I was talking about, the bigger capital cities in Australia and the bigger markets around the world come back first. For example, the US economy and the Chinese economy generally lead us out of recessions because they're the biggest and they get back on their feet first. Similarly, the Sydney and Melbourne property markets do the best recovery soonest because they've got the biggest populations and the most diversified economies. Plus also the government spread the most amount of money into those areas to reboost those economies first to get things going. And then what happens is we get a buying opportunity for stocks or property in the mid-cycle, and then the secondary markets do better. So in the second half of cycles, generally your Adelaides, your Brisbanes, your Perths do better. And it's kind of like that domino effect market timing, like you've heard. So from a city centre, like let's say Brisbane, the markets in the last 10 years that have done the best are closer to the city and the beach, and then it slowly ripples out until those affordable areas. And you've seen the same thing in Melbourne, you've seen the same thing in Sydney. And once it touches the edges of the cities, the high quality regional markets go up first, like the Newcastles, the Wollongongs, the Sunny Coast, the Brisbanes, the Geelongs, and then it spreads to the secondary markets. And all of that occurs over about an 18 to 20 year period and has done since the start of Australia was colonized, Europe was colonized. Even in some of these books, it's just absolutely crazy that there's been people writing about these cycles in ancient Greece and ancient Rome thousands of years ago. Like, it's actually phenomenal what you can find when you start pulling at that thread and really trying to understand what's going on. But your advantage from understanding this stuff as an investor is kind of like, well, where are we in market timing? We're in the second half of the cycle right now. Well, if everything in Sydney has already gone up 130%, but there's suburbs in Brisbane that have only gone up by 50 or 60% over the same period of time, then maybe for your next asset, looking at a market like that historically does very well long-term and in the second half of the cycle might be a better place to come from. Now, the next lesson is a really, really simple one, but again, one of the key weaknesses or challenges I see in most investors with less than 5 properties, and that is the right team of advisors. Now, it's taken me over 15 years to build my team of advisors to the point where I'm really happy with all of them. For me personally, I think every investor should start with an accountant, a solicitor, a building and pest inspector, and a property manager as an absolute minimum. And then as you get more sophisticated as an investor, or you want to take it to the next level, we also want a tax depreciation specialist, town planners, builders, engineers, barristers potentially, or more sophisticated solicitors. We also might want financial advisors in there, and a whole bunch of other people like that, including mortgage brokers, etc., that can just sort of round you out. And for those advisors, for me, I'm always looking for people that are investors themselves, that have been in the game for a long time with plenty of experience. I'm also always looking for kind people that are prepared to tell me exactly what I need to hear, that are just obsessively down one wormhole. So for me personally, the one thing I've obsessed about for the last 15 years is understanding the Australian residential housing market and buying the right suburbs and the right properties at the right time for the best possible price. And that's the business I run as well, which is Pumped on Property, the buyer's agency. But then the team of people that I surround myself in my property universe need to be super, super clever and just as obsessive as I am to make sure they protect me, they educate me, and they take me to a place that I could never go on my own. Now, one of the most common things that I've personally experienced and so many investors do is shitty advice from people that have no idea what they're really talking about, that are either too green or too salesy or have too much of a vested interest believing their own hype. As my father-in-law always said to me, Ben, don't buy your own special sauce, like keep an open mind, constantly keep learning. He was a developer that had been in the space for over 30 years and he taught me so many of the things that I now know. But I think it's really important to work on building those team of advisors, whether you go and catch up with a few different people for coffee that friends, family members, colleagues recommended, or whether you come in to work with someone like me and our business, where we just introduce you to this incredible team of advisors as part of the service we deliver. But either way, you're only as strong as your weakest team member. And I think over the next 15 years, you should be constantly ratcheting up that team until you get really solid people around you that know their shit and, most importantly, are either financially free already or on the path to financial freedom with their own assets. Now, another key lesson for me personally is understanding the KPIs that really matter. When I first started out as an investor, I thought that jumping on the sold section of realestate.com or CoreLogic, or having a look at what's for rent and what's for sale at the moment, and reading a little bit of a postcode update on Google was like doing all of my due diligence. And now I realize that like that is the absolute last thing that I do as an investor, which is looking at physical properties online. I love to look at the sold section, don't get me wrong, to sort of price the current market. But there's so many KPIs that are up the line to be able to first, before you even get to the property level, we want to select the right market, the right part of the market. So let's say it's Brisbane. Well, we know that the city and the beaches have gone pretty nuts in the last 10 years. So maybe we'll rule those ones out, or certain beaches. There's some pretty undervalued ones if you know where to look, actually. And then we go, well, okay, there's north, there's south, there's southwest. Based on my budget, I'm going to look at south, for example. And then within south, there's 90 suburbs. When I look at each of those suburbs across the key performance indicators, only 9 of those 90 suburbs make sense. And then the types of things that I start to look at that level in terms of the KPIs that matter to me is the 10-year history of performance. And you can find this super, super easy in Google. Just type in average annual growth rate or 10-year growth rate plus the suburb that you're looking at. And why that's so important is we know that Australian property has done really, really well long term. And if you're looking at a capital city or a major regional market, then we want to be finding the suburbs that have done way less than that long-term history in the last 10 years, meaning that they're the most undersupplied right now at this stage in the cycle. And so the closer to zero that number is, the better in terms of your short-term uplift. Now, that's supported by some information by Jeremy Shepherd, the owner of DSR, where he looked at every single suburb in Sydney over a 20-year period. And what he found is that the difference between the top performing suburb in Sydney during that time and the worst performing suburb was less than 1% per annum. Now, why that's so important to you is that he went on to find that suburbs that do really, really well in the first 10 years don't do as well in the second. And suburbs that do really, really poorly in the first 10 do really well in the second 10 years. Now, these are some pretty advanced things, but Googling it and that simply just looking for the lowest number is a phenomenal place to start as a key performance indicator, and the number one silver bullet that I've been able to find in terms of finding markets that are below market value. Now, obviously you want to look at things like vacancy rates, incomes, you want to look at things like the percentage of renters, you want to look at school districts, infrastructure, jobs, and all of the normal stuff. But I think once you've got that sort of city, part of the city, and the right suburbs in front of you, you really want to reduce it down to 1 or 2 suburbs that you become specialist at. And at that point, that's when you jump onto the sold section of realestate.com. That's when you look at what's for sale. That's when you start talking to agents. That's what you see what's for rent. And that's when the sort of rubber really hits the road. And I think a big mistake I see is investors go too broad. They're looking at this market, this market, this suburb, these 10 other suburbs. And it's very, very difficult. And then we end up getting the shits as investors because there's just so much information overload. And we sort of become paralyzed because of the amount of analysis that we're doing into just making a rush decision or the wrong decision. I've done that so many times myself. I remember in the past when I was younger at like 24 to sort of 30, I was literally looking at this state and this property and like 15 suburbs at a time and just doing all the wrong stuff, blowing out my nervous system and cortisol, and just completely wasting my time as well. So obviously there's a lot more in it than that, but there's a few silver bullets there that can really help get your mind and, statistically speaking, your knowledge around a suburb to be able to make a decision in 1 minute versus spending weeks and weeks or months and months looking at property in the wrong suburb because this suburb's done 12% a year for the last 10 years and its neighbour's done 5%, and you're paying 70% more than you need to without even knowing it. Now, I only briefly touch on this 9th one, which is a key lesson that I've learned, obviously from buying $500 to $550 million worth of property. I've learned a lot about negotiating. A phenomenal place to start is a book by an author called Roger Dawson called Secrets of Power Negotiating. Very, very good place to start. Those masterclass things that you sometimes see on YouTube as well, some of the best negotiators in the world from the FBI and the CIA and some of the biggest business leaders also run a whole bunch of courses on negotiating too, which are really cool. I subscribed to that for a few years and just went through all their content as well. But effectively, when it comes to property, the better that you can negotiate and communicate, the better you can do in terms of your buying. Now, at different times of the cycle, for example, in Perth right now, or Adelaide right now, or Brisbane right now, prices are moving very, very quickly, as we've all seen in the last 12 months. And houses are selling in sort of 1 to 7 days right now, or good quality ones are. So you're not going to have as much room for negotiating in those markets as you might in a market that's going down or completely flat at the moment, like somewhere like Melbourne, for example, or Darwin, or Townsville. But negotiating is really, really important. Now, for me, I've done videos on this in the past, which you can check out on our podcast or YouTube. Just search Pumped on Property, and then in our videos search tab, search negotiating. I've talked about in those videos the 2-step negotiation process that we use in a hot market and the 3-step negotiation process that we use in a cold market. We use them every single week to buy incredible property for our clients that work with us through our BA. Now, the 10th lesson, or the last lesson that I've learned, which was by far the most painful, is when I read Rich Dad Poor Dad at 22 years of age, I remember just going, I just want to be wealthy. I want to be financially free, and this all makes sense to me. And I set a goal of, by the time, because I didn't finish uni till I was 24 and a half, and I didn't buy my first property till I was 24, bought my second when I was 25. I basically said that I wanted to be financially free and financially independent by 30. Now, that's so common to overestimate as investors what we can do in the next 5 or 6 years. But the reality that I've learned is it does require discipline. It does require consistency. It does require a very, very clear plan. It does require sort of financial clarity to achieve something 10 or 15 years from now. And unfortunately, I hate to finish the video on this note, but it's going to be harder and much longer than you expect it to. I'm 15 years in now. I bought 18 investment properties myself. I've talked to over 5,000 or 6,000 investors. I bought over 1,000 property for those guys, and I've still made a heap of mistakes, and it's still taken me so much longer than I thought it would to get to financial freedom. But what I can say is the activity is so fun. Like, it's so different going to work. When you're going to work to earn money, to invest that money that's going to get you financially free in 15 years instead of 45 years. It's so rewarding that as you get closer to financial freedom, you can stop doing the work that you don't enjoy, and you can stop spending time with the people that you don't want to spend time with. And on the flip side, the positive side, you can start doing meaningful work. You can start that business that you want. Your partner, if they're not enjoying work and want to spend more time with the kids, can cut back at work. You can travel more, surf more, train more, help people more. And you don't have to be financially free necessarily to be doing all that stuff. You just need to have financial peace, which is the period before financial freedom, where you've got the assets that will make you free. Now it's just chipping away at the debt slowly over time. And to be in that phase, you don't necessarily need the larger income and the crazy saving strategy that you do when you're buying those assets at the start. I think for me, what I've realized is that for most people earning 100 to 300K per year, you really are kind of looking at 15 years minimum to replace that income. And if you're balling out, maybe you can bring that forward a little bit because you're earning so much money that you can pay off debt a little bit faster, or you can buy some extra partner properties that you sell off in 15 years to pay off the debt. But I think as investors and homeowners and single people or people in relationships or mums and dads, we should all have a goal of retiring early and helping the world become the type of place that would be stoked for our kids to live in, and serving others and contributing more. And for me, I've learned so many things. I've done other videos where I talk about my horror stories and the 10 worst things that have ever happened to me. And there's a lot of shit that's happened along the way that you wouldn't even believe as an investor. Going through that stuff, it's made me stronger, tougher and more clear, and getting closer to that financial freedom point in my own family has meant that I'm becoming more of the person that I was born to be, I see myself as, and I want to be on a daily basis. So I hope you've enjoyed these 10 lessons from my experience of buying over $500 million worth of investment property. It's not always easy, it's not always simple, but it's absolutely worth it. And I'm super excited for you guys to share some of the lessons that you've learned in the comments below as well as some of the cool things that you're up to as investors at the moment. Let's keep the vibes high, the positivity there, and create a community of people that lift each other up, where we can talk openly, where we can raise ourselves up and become the best versions of ourselves as investors, using history and lessons that we can share with each other to become financially free in the next 10 to 15 years. Cheers, guys. If you're thinking about buying an investment property in the next 3 months, then the team and I over here at Pumped on Property would love to offer you a free one-on-one strategy session. To book your session, all you have to do is jump over to www.pumpedonproperty.com and click that free strategy session button. Now, in that session, we'll talk about exactly where you are right now, where you'd like to be longer term, and educate you on the current state of the Australian property market. And then you can take that information with a grain of salt and go and absolutely smash it on your own, or potentially become one of the small number of clients that we choose to work with each week. But either way, we wish you all the best on your journey to financial clarity, financial peace, and financial freedom.